Hi and welcome to the Market Alert for Friday, the 22nd of January 2020. So futures and global markets hit record high amid unstoppable trader euphoria. Well, we'll see how much longer this lasts. It says high valuations could find justification in strong recovery that we expect, while inflation assets remain in the affordable zone. Well, that's until Joe shuts down America with the increase in coronavirus and COVID cases. And the 100-day mandate has already started that with having to wear masks for the next 99 days now. So I wouldn't be at all surprised if he doesn't shut America down so he can achieve his goal with the WEF in building back better. But first you've got to destroy what's left. So there's still more here with record Wall Street euphoria is about to trigger first a Bank of America sell signal. What's interesting here is that first was Citi, then Goldman. Now Bank of America turns to warn the market's excess euphoria is about to cause some pain. And that's going to come tied in with, as I say, COVID measures that are going to be coming forward. And yesterday, the weekly claims, 900,000 Americans filed first-time jobless benefits last week. Initial jobless claims remained depressingly high last week, and they're going to continue down this route as well. So you've got this polar opposite here. You've got the market euphoria, but the reality is that people are still losing their jobs at the rate of 900,000 per week. So let's have a look at the implied volatility before we get into the markets. We know the markets are on the all-time highs, and I was asked a question yesterday about the longer-term charts of implied volatility, which I have created over the years. But let's just start where we are with yesterday. The market still buoyant about Uncle Joe, and you can see they're down at 1631. But where does this fit in the bigger picture? Well, let's just move forward. Let's just have a look. We can see we're still green again in the sort of short-term charts, but here's the long-term chart. This goes all the way back to 2006, all the way to the present day. And you can see that when we used to get down into these sort of lows of 10%, we would get a market correction. And you see all of these spikes here where the market volatility moves up, or the implied volatility moves up, we get the correction. Now in 2008, we had a massive spike to 72. And in last year, when COVID hit, we had 86%. So you can see these are the real crashes, the real corrections. The only difference is in 2008, it took 800 billion to kickstart in QE to get the markets moving higher. And all of these other spikes that you see here, I can guarantee you, were more money printing to actually bring the market back. And you'll see where the markets come back off all of these corrections. And they were all assisted by money printing. Exactly the same here. This was 6 trillion. Go and see the video that I recorded last year. With regard to this, they said that the COVID stimulus was 2 trillion. It wasn't. It was 6 trillion. Where I took it apart and found the other 4 trillion that went into central banks because there was a dollar liquidity issue that arose from the 17th of September 2019 on the repo market. So as we look down here, we can see that we're still a long way from these lows, but then we're in a different situation than we were this time or on any previous correction, in that we're dealing with a global pandemic, and there is always the risk that this isn't going to be over for a long time. So the option sellers aren't going to have lower premiums. It's as simple as that. This is sort of the new sort of level at this point. I mean, can it go back down to the levels that we saw here last year where we're down at 10%? It could do. There's no doubts about it if they pump money into the markets. But if you look at the bigger picture, you can understand why the option sellers are keeping the premiums relative high to the potential risk going forward. So there you go. That's the bigger picture. That's what I'm seeing as far as the implied volatility. But it's a great indicator for advance notice, and sort of 16% is really low compared to where we have been with this. As you can see, we've been in the around sort of 18 area where with the last low, and we had a bit of a correction here and there, and here as well, and then it's dropped down. But 1631 is the lowest since the onset of the COVID crisis of last year, which is coming up to 10 months now, or just over 10 months. So it's indicating, as Bank of America are saying and everybody else are saying, that the Euphoria needs a correction. So let's see what happens there. Let's have a look at the daily chart of the Dow. And we can see there's some weakness here. So we're talking about the US. Let's just bring this over and have a look and see where we are. You can see that yesterday the market really struggled with the previous days. Not the previous days. The high that we had back here, which was 8th of January. We've got a new all-time high here for yesterday, but the market didn't really want to drive through this. And you get this. You get the euphoria of the new kid on the block, and then you get the correction because the market thinks, well, now what's he going to do? And in this case, couldn't be even more spot on, frankly, with what he's going to do. We know what he's going to do. He's going to print and print and print with his mate Yellen. This is, as I said before, it's Obama 2.0. If you'd have been in a coma and woke up, you'd have been asking the question, well, what happened to Obama? That he's not president anymore, because he's got exactly the same people, or more or less the same people, on board. And we know what happened from 2008 to 2016. They just printed and doubled the debt. And to double the debt where they are now is going to take some doing, but believe me, they will do it. They'll achieve it. When you look back in 4 years' time, you'll be amazed at how much money they will have printed, because all you need is a correction in the market now, big drop, and they will want to print to save it. It's as simple as that. That's the pattern. That's what they've done for the last 12 years or more now. Whether they can or not, of course, remains to be seen, depending on whether people say, do you know what, enough is enough, I'll have the profits, thank you very much. And how much longer can they save the market? You know, these are questions. It will go down at one point and not come back for a long time. So to come back from last year from the correction is quite miraculous. Or not correction, but from the major sell-off from the coronavirus. But when you print 6 trillion, and that was the first tranche, and don't forget they've printed another couple of trillion in between that, and another 1.4 trillion between Christmas and New Year. So the DAX didn't even make any headway yesterday. It traded up to, as we can see there, the 78% retracement, and the market's got a lot of indecision there, a lot of volume as well. Price is currently sitting at the 38%. Any rally really is starting to look like the market is moving south. There's a bit of a change in feel, and also the way it looks on the charts as well. Joe Biden's in. The market couldn't go back to the all-time highs. That's the thing here. What can they do in Europe to bring the market up? So we are sort of in that sort of, the honeymoon is over already. It only takes 1 day, and we're starting to see that there's some weakness around. You never know, though. Once they turn them printing presses on, anything can happen. In the 2-minute chart overnight, the market's fairly quiet. Let's just compress everything, move over to midnight, and you'll see the market open below the DP there. We've actually crossed the 200. It's now become a resistance here, and price is trading back towards it. But at the moment, very much a sideways market, sitting at the 38% retracement in this market from this high to this low. So 62 takes us below the 20 bar moving average, and 50% puts us, the 20 bar moving average, and 50% puts us on it there. So let's see what happens today. We have got news this morning. It's a pain, this news, because it's all of the flash news, and something's not right here because that's not the right time. Right, that's better. So this morning, lots of flash news, which is a real pain, because you get a signal and then before you know it, you've got the next news item coming out. So 7 a.m. we've got, with the futures market opening, we've got the retail sales, and then 8:15 it's the French, the German, and then the European flash, and then 9:30 we've got the UK, and then the US at 2:45. That's out again as well. So let's have a look at yesterday's price action, see what the market did. As suspected, the market moved higher off the opening of the futures market. As we saw there, went straight back to the high that we also discussed in yesterday morning's market alerts. And then prices were stuck at the high. Market opened, shot up very, very quickly, but soon ran out of interest. As you'll see here, the market volume or more or less the same, but making no headway, and then the volume just disappeared. And then we see prices showing potential weakness here. I'm just going to fast forward through this so that you can see. If we have a look here, the market all of a sudden said, you know what, we're at 78%, which we just looked at in the daily chart, and let's have a shakeout. The market shakes out straight down to the previous day's high, and then we get a straight reversal, and you can see here that the volume is greater than the previous bar. They all just bought back at the high to hold it on this occasion. So price is now moving back, stop at the 62% retracement from this high to this low, and then trade up towards 89, 78, 89. And then we see prices trade more or less to the high to the left, which is the 78% retracement in the daily chart, and then an increase in volume there, and the prices then moving low. And again, you can see this is just trying to hold above the 14,000 level, and then prices start to be bought back here. And what I'm doing here is showing you how they bought back at this level. You can see it here, and this is this level here. You can see inside of this bar, particular this bar here, the green bar, it was down and then it was up, and you can see there in the 1 minute chart how much buying came in at the bottom of this bar to bring the market back, creating that straight reversal. So in fact, in the low of this bar is the low of here, where you see the buying pressure coming into the 1 minute, and then you see the buying come into the bottom one to bring it back and complete it with this bar. So yeah, the market finding some supports there as well, but not holding, and prices trading down to 89%. They test the market at 89%. We see this with the green bar there, and then we bring the market back up to 62, and then the market gets into a sideways move as prices then break through the high and the 200, and then you see some more buying coming back into the markets, and then prices just trading sideways, and you get this sort of great big reversal bar here, bringing the market back. As I said before, if they don't want the market below the high if they can help it, because it adds to weakness, but the more difficult it is to get back above the high, then the more the market will tend to move to the downside. So here you can see prices being brought back, and I'm just going to wind forward because then we get to the end of the 10 o'clock session, and then you can see there in the daily chart we've got this weakness already. And then in the afternoon, unfortunately I was only here for the one trade. I had another hospital appointment, and prices traded down to the DP, and I decided to jump ship, as you can see. And then unfortunately there's no other markings on the chart because I wasn't here, missing it in action, as they say, and prices were brought back. We had a buy signal, and interestingly there you can see you've got that selling pressure already triggering and preempting that the market was struggling on the upside. A few more ticks before prices reversed and then moved back down towards the DP, and then just stayed in a range. So basically what we're seeing here is the market's reaction after Joe got in, and they're not really that impressed at the moment. So the market definitely needs a shakeout, and the way they'll force that is to send the market lower, and that will get Yellen to get a checkbook out and to start writing some checks. Now, just before I finish, I don't think I covered the 2 minute chart completely. I just wanted to have a look, see where we were. We've got the low here, the S1 and the DP. We're sort of 50 points either way at the moment to these sort of areas of support. Okay, that will do it for this one and for this week. So have a great weekend. If there is anything else to report, I'll let you know. But otherwise, as ever, thanks for watching. See you in the next one.